guys? This is Frederick here with Imperial House Partners, and I have a special guest, John Hegglin, loan expert, certified mortgage consultant. Barrett Financial is in the house to talk everything mortgages. We're talking rate stacks. We're talking animal fries. I'm sorry, secret menu. We're talking buydowns. We're talking assumptions, porting of mortgages, creative stuff, and more. John, welcome. Thank you so much. How you doing today, sir?
Doing great. Thanks for having me. Be happy to get some answers to some of the questions you might have.
Yes, absolutely. So we're talking about, ways that people can sell their house and keep their low interest rate mortgage. And I've covered a lot of different things, but right now I wanted to specifically talk about interest rates since they're a hot topic, right?
Right,
is the Fed going to lower them in the future? Are they going to hold steady? I know. But then what's that going to do for housing prices? All that and stuff we're going to touch base on. So John, why don't you tell us a bit about yourself, your background, what you like to do for fun, just whatever you want to share. Go ahead.
Yeah. So again, my name's John Hegglin with Barrett Financial. I'm in Gilbert, Arizona. I've been in the mortgage business now for 24 years as an underwriter, as a loan officer. So been through it all, been through a huge crash in 2006, 7, 8, 9, and a little bit of a downturn last year. But we're still here kicking away and moving. For fun, I like to take my kids to all their activities. I don't really have any fun.
I love it.
The Cubs games here and there. I'm a huge Chicago Cubs fan. But other than that, that's about it.
Awesome.
Yeah.
Awesome. I love that. I love the fact that you say that your fun is your kids, because come on. They're only small for a short time, and it's just gone. So
yeah, exactly.
All right, John. So a couple questions I had asked of was, what is a rate stack, Fred? What is a rate stack? So I talk about how I know that rates depend a lot on not just the Fed funds,
right,
but each lender, depending upon their level of how they operate,
right,
sets their mortgage interest rates accordingly, right?
Right.
So they all vary. So I want to talk about some examples in the future, and maybe we'll talk about all of them. Maybe just we'll pick one of them, but I want to talk about a standard scenario in 3 different ways, John, in addition with the rate stack. I want to talk about a 620 score type of loan, maybe a 680 score, the next low tier, and then maybe like a 720 score. And then to keep things easy, I want to do, a 20% down scenario or 80 loan to value.
Okay.
And I want to keep stuff pretty simple, max what standard, 35, 40% debt to income ratio on the back end.
Okay.
Stuff like that. So what is a rate stack?
So the rate stack is just the range of rates that are available. So when the Fed raises the interest rate or lowers the interest rate, all the rates stay the same. It's the same rate stack. It's just how much does it cost to get the particular rate that you want that day. And that changes every single day. So, you could have anywhere from, 4.99% up to, 7.875%. Obviously, the 4.99% is going to cost a ridiculous amount of money. And the 7.75 is going to probably give you some kind of credit. So you can pick the rate you want in the rate stack as long as it follows the guidelines set forth now with the Dodd-Frank legislation. You can only buy so much before it fails the qualifying mortgage calculation. So it's about 3% total.
Okay.
About where you can go. After anywhere past that, it's going to fail the qualified rate. So if the example you have for the 620 credit score, right now you'd be looking at, for conventional, would be about 7.125 on a 30-year fix. And that would be, with about a point in cost, because the rate, conventional and 620 don't really mesh. It's just a lower score.
Okay.
So, but going with your scenario at 20% down, if I did, let's say $500,000 loan amount, 7.125 would give you a payment of about $26.95 without principal and interest.
Yeah.
And without, principal and interest, not taxes and insurance.
Right.
Now,
that's just PI, right? PI.
Right.
Not PITI. Right. Yeah.
Right.
What is PITI?
Is when you add tax and insurance. That's when you take the principal and interest, which is at $26.95 I gave you, and then you add the monthly cost of your taxes, your property taxes, and your homeowner's insurance onto that if you escrow the account. So that total payment is what is the PITI payment. So that's everything together. Not including the HOA if there is one.
Okay, I was just going to say, are there any other incidentals, add-ons that you might come across? And you mentioned HOA. Anything else that might be an add-on that a person might see?
The HOA is really all is really all there'd be, unless there's some, the taxes and insurance. There could be some kind of county taxes or state, local, federal tax, to add in there. But typically it's just property taxes and the homeowner's insurance, and then you take the principal and interest and add that together. So in that first scenario, at a 620, conventional, you'd be about $26.95. Now, because you're putting 20% down, you don't pay mortgage insurance. The thing with this is, because the rate's higher, that probably at that score is not the best option for your buyer, for the borrower. At that score, you probably won't want to look at an FHA loan. Now, even though FHA is going to require mortgage insurance, the rate's going to be much lower. It'd be about 6%, and that would give you a payment, principal, interest, and then mortgage insurance. With those three together would be $25.73. So your buyer would save about a little over $100 a month.
Over $100, yeah, okay.
Just going to FHA. The rate stack on that is going to be, you're probably going to, with that type of score, you're going to stop at probably 5.875 would be about the lowest you could go before it fails the qualified mortgage calculation. And then you could go as high as you want, up to probably 7.875. And that would give you roughly about a $4,000 credit that you could use to pay for closing costs.
I was just going to ask, John, why would a person choose, in a rate environment of, 6.5? Let's just say that's a nice middle ground number right now.
Right.
In a environment of 6.5 interest rate, why would a person choose to go to 7 or 7.25 and stuff? I mean, talk about that. You said you can get a credit back?
Yeah. So let's say they have enough for the down payment, but maybe not enough for the closing costs. So we have the option to take the rate a little bit higher, and still fit into their budget, but at a higher rate. The bank actually gives a credit to that buyer that they can use to apply to closing costs. So here in Arizona, closing costs typically run 2 to 3% of the loan amount. And if we can give them 2% of the loan amount, it helps reduce their costs on the closing costs that they have to bring to close.
Awesome.
So that helps them too.
I love it. So guys, what John just said is, if you're tight on money and can afford the little bit of bump in payment per month, you owe it to yourself to ask your loan officer. Why not ask John? But ask your loan officer about possibly 0.25% higher rate. Again, there's got to be some qualifications involved, but that can offer you money back to your house, and you can spread basically that money over time. So that way you're keeping your cash for now purposes, like maybe furnishings, maybe some repairs that you have to do right now, and reserve that money to do that, John. That's awesome. I appreciate that. I was just my next question I was gonna ask you, and you already read my mind. How low does a rate sheet typically go, and then also how high? And I think you just gave us the answer without even thinking about it. You said like 4.9 or 4.99.
Yeah, it depends. It depends on the credit score, the initial, what that credit score is going to be. But so I'll give you the example right here of this scenario. Going, what is this? FHA. The lowest rate you could get at this 620 scenario is 5.25. Right now, it's going to cost you almost 6 points to get there, which in this scenario at $500,000 is over $22,000, almost $23,000.
Right.
That rate, which in essence it only gives you a savings of roughly $300. So
wow.
It's not going to pass the qualified mortgage calculation.
Right.
So you wouldn't be able to buy down that much. But let's say you wanted 5.875. That would cost you a little less than 3 points, but it costs you about $11,000, and it's going to save you $200 a month. So what you want to do, and this maybe is one of your questions coming up, is you want to see if that's worth it. Is paying the extra cost worth the $200 a month savings? Is that going to make sense for you? And it depends on how long you're going to live in the house. Most people live in their house. Yeah, most people live in their house for 3 to 5 years, and then they sell it and upgrade or downsize and move on.
Hey, John, I'm going to stop you right there real quick. 3 to 5 years is the average a person lives in a home. How do you think that's going to be influenced by the huge amount of loans that were made during 2020-ish through to 2022?
Right.
When rates peaked at their bottom. Right.
People are not wanting to sell right now.
Right. Do you think that's going to influence them keeping their homes longer? Because back when I used to do loans, because I also did loans back in the day, the average time frame a person kept a home was about 7 to 10 years. Mm-hmm. So that's dropped by half.
Yeah, it's dropped by roughly half. And right now, people are holding on to their homes. What we're seeing is in this model in Arizona, particularly. I'm not sure how California is, but people are holding on to their homes because they want that low interest rate. They're improving their home. They're making home improvements. They're putting in pools. They're putting in new flooring, granite countertops. Painting. Putting in solar panels. They're improving what they have because their rates are so low, and that's keeping the inventories low. Eventually, though, these people are going to start selling, and we've already started seeing a movement this year with people listing their homes to try to upgrade and get to new homes. So it's starting to happen. Will people live in their homes a little bit longer because they want to keep the low rates? Probably. You might see it creeping back up, the 5 to 7 year range before they think about selling. But some people, it all depends on the person's motivations to move.
Yes, that's right.
Maybe their kids are out of the school district now, and there's no reason for them to stay in the big house anymore. They want to move to Hawaii.
Are you talking about right sizing, John? Right sizing.
Exactly.
That's right. Right sizing. All right. So rates kind of range on a rate sheet, all depending upon credit score, obviously.
Right.
That's going to change the bottom and the top.
Right.
Sliding scale. Okay. So, I've some lenders I know have a secret menu, kind of like In-N-Out. Can you say animal fries? I mentioned that in a discussion. Is there a secret menu with lenders, John? Is there one like that?
I wouldn't say there's a secret menu. I would say that sometimes, I've had some realtors call me and describe scenarios that, they told the buyer that there was no option for them. But in most cases, there may have been an option. And if I can give you a example, I had a realtor at an open house talk to a couple, and they were Muslim, and for religious purposes, they're not allowed to pay interest. So she just told them there's not an option for that, and that she couldn't help them. And then I talked to her a week later, and she told me what happened, kind of jokingly. Can you believe what they wanted? I'm like, yeah, but what if I told you I have that loan? I have that loan. Right. It's called a halal loan, and we can, there's a way to set it up to do it. So I would say there isn't really a secret menu. It's just people don't ask. And that's part of, my job as a loan officer is to kind of dig into what you want and try to find the program that's going to fit for you. And I tell my realtors that I work with, hey, if you get a scenario that you think can't be done, just call me first before you give a definite answer. Yep. And I'll let you know. We have 160 lenders that we work with, and if I don't have it, it's probably not there. Or maybe we don't have it, but I know someone that does, and I can tell you where to go.
Right. Now, John, Barrett Financial is what's known to me, and help correct me if I'm wrong. It's a mortgage banker and broker. Is that correct?
We are both now. Yes. We're a banker and a broker, so we can fund in our name, which we're doing a lot of now. But we can also broker out the loans that maybe we're not able to do. But we have 160 different lenders that we can go to kind of fit whatever scenario you have, whether it's you have perfect credit or you have a 520 credit score and you want an FHA loan. We may have an option for that as long as you fit the qualifications. VA, FHA, we can actually go down to a 500 credit score, with a bigger down payment for FHA. So there are different things that we have and have available. So sometimes people just think the loans stop at 620 or loans stop at 580. They don't. We can go farther down. They're a little bit tougher to do, but we can still do them. So the secret menu is don't be afraid to ask.
That's right.
It's there. If you want your, McDonald's has their way of serving their hamburger, but I don't like pickles or onions, so I have to ask for it that way. Yeah. Right. Yeah. So if you don't ask, you might not get it.
Right. That's
just asking. You might have it.
I love that, John. We can have a whole conversation on just different loan products and types and the benefits that they can offer people. But right now, we're going to get to our next thing. Do rates ever go on sale, John? On the rate stack?
Sometimes the lenders will give us incentives for refi. Like right now, we have a lender that is giving us 100 basis points, which is about a quarter in rate on rate and term conventional refinances. Okay. So we're able to get a few people that wanted to kind of lower their payment. This program, which runs out at the end of the month, that help them do that, help them refinance and get a better rate when they might not have been able to in the current market rate environment. So sometimes there are rates, and some lenders have incentives to get things going. So yes, it is sometimes true.
All right. Yeah. Awesome. So now let's talk about more of an option that people may not know about, or maybe are confused about or uninformed. It's about education, John. And I want to talk about interest rate buydowns. both
Okay.
permanent types and temporaries, and maybe some of the features and benefits, that they offer.
Sure.
So let's talk about Buydowns.
So rate buy down is, let's say we have I'll lose my current stack here, that scenario.
Okay.
Wanted an FHA loan with no points. You'd be looking at with that 620 score, you're probably looking at about 7%, 7.125.
Okay.
If you want to buy down the rate, which is a permanent buy down, you're paying discount points, and let's say you want to get it to 6.490%. We could do
basically
that.
6.5%, basically.
Right. Yeah,
Okay.
and that buys it down. That would cost you, with that scenario, about, 1.5. But then you'd buy the rate down, which is a permanent rate buy down by paying the discount points. So that's one way to do it. There's new programs out now to kind of offset this higher rate environment, which are temporary rate buy downs.
Okay.
And you can do a 1.0 buy down, which is, let's say the rate starts at 7%. With the 1.0 buy down, you would have an interest rate of 6% for the first year. And then after that first year, then it goes back up to 7%. It stays there the remainder of the time. What that would do,
and that's a temporary buy down, correct?
Temporary.
Okay.
Yeah,
So 1 year of a temporary low payment. Again,
right.
They should weigh their options, and that's why
there's also a 2.1 buy down, which is the same scenario. So it would start at 7 the first year. You drop 2%, so you get 5. The next year it would go to 6. And then for years 3 through 27, if you get the house for 30 years, you're back at 7% fixed. So it just helps you with the initial couple of years to get the rate down. Now, these are typically going to be funded by the sellers. So you'd have to ask for seller concessions. It is available where the lender pays for it, but the rates are going to be higher. So you get your best advantage on this is if you ask the seller for a concession. And then what I would do is, if you wanted this program, is I go into my rate buy down calculator. We figure out the home you want to buy, and I would send to your real estate agent, here, this is exactly how much you have to ask for this buy down from the seller. And usually on a 1 year buy down, it could be less than 1%. On a 2.1 buy down, it could be over 2%. There's also a 3.21 buy down, but that never passes the qualified mortgage calculation. That always fails. So it's nice in concept, but never works. So
and that's because of the limit that Frank Dodd has in the amount of contribution that a seller or lender can give to a borrower, correct?
Right. Yeah. I mean, the seller can give on different scenarios, up to 6% seller concessions. Just the amount of that concession that goes to the cost of the rate is where you're limited.
Gotcha.
So
okay.
They can pay, they could pay, up to, say, they wanted 2% for the buy down, and then they want another 3% for the closing costs. That's doable because you're using, you're not going crazy with the interest. So that's doable. So there's a spot that on the interest rate where you have to stop, otherwise it fails. Again, what's called the qualified mortgage calculation, or we call it QM. We never want to see a QM fail, because then we got to restructure it, and it's a big mess. We try to make sure that up front it doesn't happen.
Now, I know consumers don't really get into the weeds about qualified mortgages because that's not really a term that's out there for the consumers. But just for this audience here, qualified mortgage is what you're talking about, ones that conform or meet certain standards of underwriting guidelines put forth by the federal government, correct?
Right. We're talking Fannie Mae, Freddie Mac, FHA, VA, USDA, the normal loans. Those are the ones that are bound by the Dodd-Frank Act to fit within certain fee structures and criteria. So we have to follow that law to make it work.
Gotcha. So what makes a loan, in the most simplest form, what makes one non-qualified or non-QM, so to speak?
Right. Those are the ones where they don't fit the guidelines for Fannie Mae, Freddie Mac. And then we have what are called non-qualified mortgage or non-QM lenders, and we take it to them. Let's say they can't qualify on their income.
Okay.
But maybe they're self-employed and they write a lot of things off, and we can't write it back in. But they have a profit and loss statement that their CPA has prepared and said, well, his income is not what you see; it's actually this. So we can use that in a non-QM loan to make the loan work. Now the rates are going to be higher.
Right.
You can get someone a loan that typically wouldn't have one, and then maybe in a few years they'll change how they file their taxes, and then we can refinance them into a qualified mortgage. Or a lot of times these people have a lot of money, they just don't show it, and they pay it off in 3 or 4 years. So they just need to get the home, and this is an avenue for people that maybe don't show their income or can't document their income to get into a home.
So folks who are self-employed but not just self-employed, but folks maybe who are in the gig economy,
Yep.
Door Dashers, Uber drivers,
Yep.
kind of service provider freelancers, stuff like that.
Yep.
There are options to get home loans for those people. Is that
Yes,
correct?
there are definitely options to get those people into homes.
No, that's
We can do bank statement loans, or like I said, profit loss, loans. There's ways we can get people into homes that normally wouldn't qualify. So those are options.
I love it. And having more options, to me at least, John, means that people have more access to housing, and hopefully affordable housing with lower interest rates and
Yes.
pricing being changes and initiatives going out. Different states have different programs, grants for first-time
Right.
buyers and stuff like that.
Yeah.
When would you say, John, is a scenario where a person shouldn't buy a home? Maybe they have income, maybe they have a job, right? Why shouldn't a person buy a home? Is there ever a reason? Or get a loan for a home, I should say.
I mean, if they're not financially, we're going to be responsible. But we typically would see that in their credit, and it would make it difficult for them to get a home. Some people just don't want a home. They don't want to own. They want to do other things. They're always on the move. They're a year in here, they're a year there. They're kind of nomads. They want to move around the country and see. They want to live in Costa Rica for 3 years. It just depends on the individual. Some people it's not their thing, and that's not a problem. Some people want to rent. And that's perfectly fine too. Yeah.
There's a lot of that going on these days, John. There's
There
a
is.
lot of rentals these days, let me tell you. And there's been
There are.
talks that the government is somehow, and I don't have any opinions on this either way, I just, what I read and hear about.
Right.
The government and whatever you want to call it, the man, I guess,
Right.
is trying to keep, consumers on a rental platform, by making homes so unaffordable, because it's a pattern that we keep seeing.
Right.
A lot of injection of cash causes inflation, which causes prices to rise. I mean, come on, look at everything now, John,
Right. Yeah. I mean, there is right now. You could say there's some market manipulation happening where, inflation is where it's at, and if things shouldn't be where they are right now, but they are. So that's just kind of where we're at. And there are programs to help if low to moderate income people get into homes. It is available. You can even, if they have guaranteed Section 8 income, which is rental assistance, and they can use that to buy a home, as long as they can provide the proper documentation. We can use that to offset some of the debt to help them buy a home. We have a program right now where if you rent in a low to moderate income neighborhood, let's say you had to go there because you couldn't afford anywhere else, but now you have a great job. As long as you're renting in that low to moderate income area, you could buy anywhere, and there's no income limitations. And you get a $5,000 closing cost credit. You also get $500 towards a home warranty and a $500 appraisal credit. So there are programs out there. You just have to ask and see what we have available.
Amazing. I mean, wow. A question that I get every now and then, haven't had it in a while, is there a program for would-be homebuyers that have no credit?
Yes.
Meaning you run their credit and their name and stuff shows up, but they have no score.
Yes.
Because they have no trade lines per se.
Yes. Yeah, we can do that. That's an FHA loan, and we just use 3 alternate trade lines. And alternate trade lines can be any account that they have that they pay monthly that they have not been laid on in the past 12 months. Could be a car, car loan, auto insurance, cell phone, cable, Netflix, health insurance, something they paid on for 12 months. Even their renter's insurance, or even their rent, they have to be living somewhere.
Even their rent, yeah.
You can use that as a trade line as long as there's no mortgage lates in the past 12 months, or late payments in the last 12 months.
Right, yeah.
I should say. That's an FHA loan that can be done. So if they have 0 credit score, we can do it.
Okay. How about folks that have bad credit? For whatever reason, they lost a job or got injured, or life happened and it affected their ability to make payments. And the role.
Right.
Get down a few months and that score is in free fall mode. It is going to drop 200-300 points and decimate your score into the 400s. So are there hope when a person gets out of that mess, meaning they have a job again and they're starting to play catch up, but their score is so tanked?
Right.
Do you have any tips, ideas on ways to get people to a higher score in maybe 90 days or 6 months? What would you recommend?
Yeah. So what I can do is when we pull their credit, if it's not where we need it to be, or I can't get an approval for them, I can run a credit simulator for them and let them and give them a roadmap. Right? It'll tell them exactly what they need to do, exactly how much they have to pay off to get their score to a certain level. And if they follow that guideline and that roadmap, whether it's going to be a month, we can, if it's simple, we can restore it in 7 days. If it's more complicated, it might be 6 months. But I'll give them the information that they need to get their credit where it needs to be to buy a home. Just a matter of when they can do it. So as long as they follow the roadmap and keep making their payments on time, we'll get them there. Like I've been working with some people now for 2 years, and they're just to the point now where they're ready to start looking. So whether it's going to be we can get you closing a house in under 15 days, or it's out to work with you for 2 years, we'll get you there. You just got to follow the plan.
I love it. John, is there anything else you'd like to add to the viewers who are watching this video who want to know more about how interest rates work, how to find the best terms for them, and to be able to buy that house or sell their house and buy a new one?
Yeah, I mean, for interest rates, I would definitely tell you to shop your mortgage. Don't just go with the lender that your realtor recommends. Shop it. See what's out there. Maybe there's different programs available. Maybe there's different down payment assistance programs available. Like we have probably 12 different down payment assistance programs. One of them a little bit different. So just going with a lender that has 2, you might be shortchanging yourself. A lot of times you'll get referred to a retail loan officer or a bank who has very limited programs, and they're typically higher costs involved in going that route. As a mortgage broker, there was a survey done in 2021 where if you went with a mortgage broker, the buyer actually saves about $9,400 over the course of the lifetime of that loan, just by getting a better rate, lower cost. And minority home buyers actually save more, a little over $10,000 by choosing a mortgage broker. So I would definitely say if you're looking to buy a home, shop with a mortgage broker, see what we can do for you. You'll be shocked at how much money you're going to save and what kind of rate you're going to get. So definitely don't be afraid to shop with them.
Love that. John, I appreciate your time so much. If anybody wants to get a hold of John Barrett, John, why don't you share with us the best ways to get a hold of you, online, offline, anytime, all the time?
Yeah.
Let us know.
You can give me a call. My number is 480-535-4620.
What was that number again, John? What was that number again?
480-535-4620. You can give me a call. You can text me. I'd be happy to help you and get back to you with, answer your questions. You can also apply directly online at www.applywithjohnh.com. So applywithjohnh.com will get you right to the application.
I'll be right down here, guys. I'll be right down here on the video. So I appreciate that. John, I appreciate you. It's been great talking with you and getting to know and work with you over the years. Thank you so much. I appreciate you, guys.
Yep. Appreciate it, Fred.
Ask questions. That's the biggest takeaway right now from this video, is to ask questions.
Yes.
If you're talking about something with your house, talk to a real estate professional. Doesn't have to be a realtor, but somebody who knows a lot about real estate. If you have questions about loans, talk to a mortgage broker. Talk to your banker, and then also talk to a broker. Talk to John. Talk to me. We both been in the business 25 years. We've been around. We've seen everything happen from A to Z. We've bought homes. We've sold homes. My first home, John, was 7.5% in 1993.
Yep. Yeah, mine was 1999 at 7.25%.
There you go. Yes. And then now think about this. 10 years after that, in 2003, I bought my next house, and that rate was 5.5%.
Yep. Yeah, I mean, it changes. The market fluctuates. What you buy is gonna, their interest rates are gonna change, but hopefully the home is gonna still appreciate, which it has been for the last pretty much 50 years, except for that the crash we had. It's still a great investment.
Yes, it is.
Great investment.
Again, guys, thank you so much, John. Appreciate you. Make sure you show John some love. Comment in there if you found this video helpful and informative, and I appreciate your time, guys. Hope you have a great day. John, good talking to you. Take care now.
Thanks for having me, Fred. Have a great day.
Thank you, sir. Appreciate that.
No problem.